Let me know. We can start what we're doing. Okay. All right. So, all right, let's get started. All right, what we're going to cover today is getting the most out of 2020 and looking forward. We're going to give you a business update, an individual update, and then we're going to talk about all the different stimulus stuff that's gone out here over the last couple of months, year almost now. And then we're going to give you a little bit of a preview of what Joe Biden's tax plan looks like. So those will be, and then Lindsay will throw in some QuickBooks stuff for you as we go along and some other small business stuff that as we go. So let's get started. So the first thing I like to talk about is, especially with a lot of sole proprietors and small business people, is this QBI deduction. And it's been around for a couple of years, but I still, every time I talk to people about it, they're like, what is this? How does this work? And so even though this is from 2 years ago with the Tax Cuts and Jobs Act, I still like to go over it just so everyone kind of, it keeps it on your mind, because it is a big tax savings for small businesses. And so anyone who's a sole proprietor, as a Schedule C, has rental activities, is in an S corp or a partnership, get a 20% deduction on their business income. And so that's, whoops, I touched it. And so, however, it's not quite that simple, because if it can be limited depending on your income levels, it could be 20% of income, or you have to have wages or property. But for the most part, it's just simple to know that if you get above a certain income threshold, your income could be, the deduction could be limited. And so we have this in here, but for the most part, if you're a small business and you're in a certain thresholds, you just take 20% of your business income and move along. Which is huge, because if you have somebody who, let's say, makes $100,000 in business, they're only going to pay tax on 80, because they're going to get a $20,000 tax deduction. So that's a big, that's a big deal, and was a big deal a couple of years ago. I provided this chart that shows what the thresholds are if you're single, married, filing jointly, or head of household, what those tax brackets are for last year, for this year, and then for 2021. So you can see that the thresholds are slowly creeping up year over year, which is to cover with inflation. But they're there. We'll provide these slides so you can have them there if you want. And so the real thing when you're talking about your qualification is to make sure that you're keeping your income below those thresholds, because they do start to phase out. For every $1,000 you get over, it's a percent reduction. It's a 5% reduction. So by the time you get to $100,000 over, you're done. 1,000 for 1%. So it goes away. The things you can do to keep your AGI low is a charitable contribution, maybe making one at the end of the year. The accelerate an expense or delay your income, maybe prepay for a couple of things, assuming you're on the cash method. You can prepay a couple expenses, and then that way you bring your income level down. Maybe that check comes in on the 30th and you don't post it till the 2nd or 3rd. He gets kind of mad about that, but you could do that, and then you're delaying your income, so income goes into the next year. Maybe there's that piece of equipment that you really need, like a computer, or something you were thinking about buying. If you buy at the end of the year, with all the bonus and 179 rules that are out there, we are able to take usually 100% of that cost. And so that can drastically lower your income. And the last thing is, like if you can maybe make a 401k contribution if you're at wages. If after year end, you could have a SEP, a self-employed retirement plan, or an IRA, you can set those up. Those can actually be made after the end of the year. SEPs, you can go all the way out to the extended due date deadline of October. So you really have a long time to fund that. So if you have a really good year, we can tell you what that number is going to be, and then you can extend your return. You don't have to make that SEP payment until October to still get the benefit. So there are some ways there to keep that income below the threshold and ensure that you're always getting the full 20% tax deduction that you're eligible for. The next big thing is we're going to talk about is meals and entertainment. And so normally this isn't a real big thing with the Tax Cuts and Jobs Act, and they made all meals 50%. So no longer, like if you bought meals for your office and it was for just the benefit of your employees, that's no longer 100% tax deductible. Entertainment things, they're no longer deductible at all. Everything was straight 50%. So they made it simpler. And then COVID happened, and a lot of restaurants and bars and things didn't do real well. And they were the ones worst hit with this. So as part of the Taxpayer Certainty Disaster Tax Relief Act, which was happened just at the end of this year. And so they said, well, we want to encourage you to go and go to restaurants. And so they said, any meals you eat at a restaurant are now 100% deductible. So if you go out to Chipotle, or you go out to somewhere fancier, my kids, that's the only place we eat. But if you're going out to eat at a restaurant and sitting down and eating, that's 100% deductible. However, if you go and buy food at Giant for the office, that's still 50%. So non-restaurant food. So now I'm not telling you not to eat it, get Giant or fake, but if you go eat out at a restaurant, you will be able to take 100% deduction, a business meal now. Now that's only that's only for tax years 2021 and 2022. After that, we go back to the Tax Cuts and Jobs Act rules. And so that's why I include both sets of them. So that's one big thing that you need to make sure you can take advantage of this year, is maybe go out for lunch once you feel that it's safe to restaurants again. I want to take a opportunity to talk about cars, which is always a big question with a lot of small businesses, is cars. People say, oh, I'm going to buy this car, I'm going to use it for my business, and then they get 100% write-off on that new car. Well, not really. It has to be what you're using it for business. Now, if you're in the business of, yard work or lawn care, and you've got a truck specifically designated for lawn care, and it's got your logo on it, and it's got your equipment in it, and it's all fitted out, and that's the only thing you use it for, then by all means, we can take that work truck and we can depreciate it because it's a business asset. But if you say, hey, man, I'm really looking at that new car and I could use it, and I can use it for work, and think you're going to be able to get 100% depreciation for it, no, that's not how it works, because you use it for personal use. And so depending on how much personal use you use it for, you might find out you don't really get that much benefit at all. And if you're like, let's say, using it 60% for business 1 year, and then you drop below 50%, you could actually have a scenario in which you have to actually pick up income from that. So that's why, like, when people buy cars, be very careful how you do it, what method you use it, and stuff. And there are two different methods. There's the actual method, and then there's the mileage rate method. And the actual method is the one we talk about, where you get the car, you put it in, and you keep tabs on, you can depreciate it. You could also record all the gas, the fees and registration, repairs, insurance, lease payments, oil, tires, washers, and all that stuff, washes. But you still have to keep mileage, because you have to know how much of your mileage is personal and how much of it is business. And so I know there are a lot of apps out there people can download, especially with you realtors. I know you guys all have those kind of things. So you're already doing that, but you have those mileage apps and says, hey, I'm using this for this and this for that. And then that would determine what your percentage is every year. So even though you spend $150 on gas, or $1,500 on gas, and if it's only 60% business, you only have to deduct 60% of those expenses. So even if you use the actual method, you still have to keep track of your mileage. And then the other method is the mileage rate. And that's where the IRS comes in every year and they set a table. Last year, it was 58 cents a mile. You would get a certain amount of money, and that would cover the wear and tear. All the actual expenses you get in one mileage rate. And so whatever the mileage you drive for business, 5,000 miles at 58 cents a mile, bam, that's your deduction. You don't have to keep nearly the receipts. You just have to have some sort of mileage report, which I just said. They have tons of great apps out there now, it will even tell you. My phone even knows where I'm going.
I'll log in there, Charlie, and just interject. One of the apps that we do recommend for your phone, and I know KW actually has one in their portal that you can utilize. Nathan would most likely be able to help you get that installed. But Mile IQ is one that we utilize for a lot of our clients. At the end of the month, based on the business miles driven, it actually emails you a PDF and an Excel version, and it has the mileage rate at the time actually in it. So it's something that you could set a folder aside and drag and drop those monthly reports in there. We can add those onto your QuickBooks file or a part of your Excel expense tracking. And then finally, even at year end, it'll email you a summary report. I think it's $5 or $6 from the App Store, but really in the long run, it ends up being a huge savings for you. One other item I'll add when you're talking about whether or not actual versus standard kind of mileage rate comes. For anybody who usually keeps a car more than 5 years, we see where the mileage method wins 9 times out of 10. A vehicle is something when it is 100% business use can only be deducted and kind of expense the cost of the vehicle over the first 5 years. And then after that, if you keep it year 6 through 10, there's no more vehicle to depreciate or to deduct. Rather, you only get to take the actual expenses for various gas, registration, or repairs and maintenance to the vehicle. When you use the mileage method and you keep that vehicle in years 6 through 10, you get to continue using that mileage rate well beyond the depreciable value of the car over those first 5 years. So you actually, when you look at the break-even analysis, start to see it flip and then go up when you keep the vehicle for a longer period of time. We do suggest that you do not deduct those on the business side of the return. Rather, they get attached to your Schedule C. If you have a S Corp or a partnership, they should be running through the S Corp or the partnership. Don't save those deductions for your personal return. Charlie, back to you.
Thanks, Lindsay. No, I 100% agree. And then the one thing to remember if you decide to go to the depreciation route, when you do trade that car in, that's a taxable event. So you will have to pick up income from selling that car. Even if you're not selling it for cash, if you're trading it in for car number 2, doesn't matter. That's a taxable event. So that's another thing. And I agree with Lindsay is the mileage method. It's cleaner, it's easier, especially if you're in that gray area. It's a lot less audit risk. And then I have a sheet here that's providing the mileage rates for the next 2 years. So there's last year 58, 57.5. It's going down to 56. There's business miles, there's medical miles, there's moving miles, and there's charitable miles. So maybe you're doing something charitable on the side. Don't forget about those charitable miles when you're doing those things. It's low-hanging fruit, just something you're keeping track of. And with your real estate app, I'm sure it's keeping track of that stuff anyway. So it should be a really easy thing to pull off. Next, we're going to talk about the home office deduction. And people say, oh, I've got a home office. And so I really want to touch base with this because this is another area that people like to talk about. And so there are 2 different ways. There's a safe harbor, and then there's the actual expense method. All right. And the safe harbor method is they say, okay, you've got an office. If it's 10 by 12, $5 a square foot, up to 300 square feet, we'll give you that deduction up to $1,500. You can take it right off your Schedule C or your S Corp. It's low audit risk. They don't care. They don't look at it. They don't do anything else. They take your word for it almost, like LeVar Burton. You don't have to take my word for it. All right. So that's always really good. People really like it. The thing is all your taxes and interest and some of those other expenses that maybe would be shifted to personal use, you take 100% of those. They don't care about that. The downside is that it's not deductible for PA. PA doesn't allow home office. So you can get it for the Fed, but not for PA. If you go to the actual expense method, same thing, you take that, whatever that room is, and you can deduct a certain percentage of your mortgage. So if you have a 10 by 12 office and your house is 2,400 square feet, that's 5% of the total area of your house. You can take 5% of your mortgage interest, 5% of your real estate taxes, 5% of your utilities, 5% of your repairs and maintenance, and we can even depreciate 5% of the cost of your house for the next 27.5 years. So usually you can tend to get more out of the actual expenses than the safe harbor. However, there's a much higher audit risk when you do this. We've had ones where it has to be a dedicated space for your office. It can't be a place where like you've got a spare bed in it, or you've got like your kids, maybe you have like your office and then the kids have like another TV in there where they're playing the Game Boy, or not Game Boy, where they're playing some sort of Xbox or something, and things are going on in there. It's got to be completely dedicated for your home office. We've heard horror stories of the IRS coming in and auditing home offices, and it was like almost like, I don't know, like a row type house where the only bathroom in the house was on the other side of the home office. And then in order to use the home office, you would in order to use the bathroom, you had to walk through the home office during non-working time. And they said, well, then that's not really a home office because you're using it for non-home office use. And so it's a much higher audit risk. It's something they love to go in and take off. So if you have an actual space and it's dedicated for it and you meet all those requirements, by all means do that. But if not, the other thing is it has to be for your employer's benefit. So like if I'm working from home because it's better for me, right now in COVID, it's a little different. If I'm working because it's better for me, I can't take a home office for that. It has to be because like I work remotely or like you guys are self-employed, you can have a home office. But if you're working for somebody else and they have an office provided for you, you have to use that office. You can't take advantage of a second office unless it's for their benefit. So square foot, safe harbor, always good. The home office actual expenses, much more risky. The other thing that you have to always remember is when you sell if you do the actual expenses, when you sell your home, you're going to have to pick up, there's a gain that you're going to have to recognize because you've been taking depreciation expense on your house for however long. And when you sell that house, you have to pay taxes on that gain because your house is worth less and you got a business expense. So that's always there. So I just want to bring that up because that's something else that like people don't always think about, especially like with cars and with home office. People go, oh, I get all these benefits up front. And then they always forget about when I sell it or when something happens and I have to pay tax on it and they're surprised. So that's why like Lindsay and I always like tend to say, you know, the safe harbor, the thing, it's much cleaner, it's much easier, provides a lot less audit risk and makes things easier for everyone. So home office. The next thing I'm going to talk about is if you're a Schedule C or a Schedule C, you don't got to worry about this. But if you're a partnership, I want to talk about this because it's a new thing and it's something that we want to make sure that you're aware of so that when you're filing your return and someone asks you if you want to elect out of this or you want to elect into it, what it is. And so the IRS finalized in 2018 the Central Partnership Audit Regime. And it came in, and what it says is if you don't elect out, you're automatically elected in. So you have to opt out. If you don't opt out, then you have to, then if your partnership gets audited and they find that there is an error and you owe them money, the partnership has to pay the money. The way it used to work is if a partnership got audited, the partnership would have to make the changes and then you would get K-1s and they would go down to the individuals and the individuals would pay the tax. With this, the IRS is like, oh, we're going to come up with this and the partnership is just going to pay it and then the individuals never have to amend their tax returns. So the pros are it's streamlined and a lot less amended filings because they said, you know, the partnership has to be amended, then all the shareholders have to be amended. And so if you're looking at a minimum 3 tax returns that have to be amended. So they said less filing. However, in order to be streamlined, the IRS says, no, we're going to charge you the maximum income tax rate on those penalties. And so that's really the big con is possibly higher taxes because not all shareholders have the same income levels and they're not all paying the same tax rates. And so when you do that, the con is that you may pay higher taxes. And so, and then your tax matters partner gets to make all the decisions, as opposed to if it comes down to you, the shareholders get to make more of the decisions. So real pros is it's streaming, less filings. The negatives are you may pay higher taxes, not necessarily that you will, but you may, and that you lose some of that availability to make decisions. And so you have to make that decision, but in general, we recommend to a lot of our clients that they opt out if they can. And you can't opt out. You must have less than 100 partners, and a partner can't be another partnership, a trust, a foreign person, a disregarded entity, of an estate that's not from someone who just passed away, or if you have interest on it on behalf of someone else. But most of the time, if you're just a regular old partnership, you can usually opt out. And that's what we recommend to a lot of our clients. So I just want to bring this up so that way, if your accountant or if somebody asks if you see this and you're like, hey, what is this? Now you kind of have some frame of reference of what the central partnership regime is all about. And it's a question every year you must opt out. It's not something that you opt out and you're in for the rest of the time. You're opted out. So that's a big thing. we ask a lot of our clients and like, what? So I just wanted to bring that up, but only for partnerships. All right, qualified improvement property. And like, this is really big for you guys, not only as business owners, but also as selling too, because when they passed the Tax Cuts and Jobs Act a couple of years ago, they were trying to get it through. They got it through really fast. And the biggest error they made was they eliminated qualified improvement property and qualified leasehold improvements. And they made this qualified improvement property. And they forgot to write in that this is going to be a 15-year asset. And so after they passed the bill, the IRS is going through and they're saying, hey, you guys missed this. And they're like, no, that's not what we meant. And they're like, yeah, but this is what you wrote. And so for the last 2 years, all that leasehold improvement property has had to be taxed at 39 years. So not only is it stretched out over 39 years, now you can't take bonus, you can't take 179 on it. And so it made it a lot less attractive. And so with the CARES Act, which was passed last year, they corrected it, went back to 15 years. And so now you can take bonus and 179, and you can actually go back all the way back to when the Tax Cuts and Jobs Act started, and you can fix all those errors. So that's huge. Like you guys selling, maybe someone's thinking about buying a rental property or a business thing. This is a big thing for them because now their tenants can make these improved properties and get more benefits up front. And so that's really huge. And this was a big thing that they took care of in the CARES Act. And so I just wanted to bring it up that there's qualified improvement property. So if you had some leasehold improvements that you made in the last 2 years, it might be worth going back and amending those returns to get the benefit of those assets and get some money back. So, all right. So those are our main business changes that have happened in the last year that I wanted to go over. Now we're going to talk about the individual tax update. One of the big things that came out of the CARES Act was people felt they had to take money out of their IRAs because it was, they needed some money, things were tight, they took money out of their IRAs. And normally before COVID, if you were under 59 and a half and you just took it out, it was going to be completely taxable to you, and you're going to have to pay a 10% penalty, which is really steep. So if you took out $50,000 and only we're going to have to pay taxes on it, that's another $5,000 in early withdrawal penalties. So as part of the CARES Act, qualified individuals who took out distributions between January 1st of 2020 and the end of the year, all their penalties are waived. If you can prove that your business was shut down, if you were affected by COVID, or if you lost your job because of COVID, or you take care of somebody because of COVID, if you have a COVID-related reason, the IRS is willing to waive the penalties. So that's great. So there's $5,000 you save. They also said that we'll allow you to take that $50,000 that we took out in our example, and we'll allow you to spread it out over 3 years. So you don't have to pay taxes on the income all in year one. You can pay a third of it in 2020, a third of it in 2021, and a third of it in 2022. So now they're spreading out that tax burden. The other thing is they said, if you pay it back, like let's say you took that money out and you needed it. And then now this year, things are going really well. You think by the end of the year, man, I could pay that money back. The IRS is fine. We'll let you pay it back. We won't make you pick up the rest of the income. In fact, we'll let you get a refund, and as though you never took that money out in the first place. And so you can go back and amend those returns. And so that's a huge thing for people who are struggling right now, or were struggling and took money out of their IRAs and were able that they can now save, they get rid of the penalty, they can spread the money out. And if they want to pay it back within the next 3 years, they can do that. And then they can get all the taxes they paid back. The other thing is you can take a loan on your IRA. That's always an option. And if you did that, it'd go from 50,000 was what you could do. Now they've allowed it all the way up to 100,000, but it's got to be a loan after March 27th. So there's that. But that was a huge thing this year. So if you took anything out, know that there is some relief there on the individual. And then here you're a qualified individual. We have the reasons listed here. Diagnosed, spouse tenant diagnosed, experienced adverse financial consequences, taking care of somebody, or reduced hours. So as long as it has something to do with COVID, chances are you'll be okay. But if you just take it out because, hey, I want to take it out and invest in another business, that's not going to qualify. It has to be COVID related. Charitable donations. They've actually added some things in the CARES Act, try to get people to give to charity. In 2019, it had gone up from 50% to 60%. In 2020, they're now saying you can give 100% of your taxable income. So if things are going really well and you want to donate, you can give up to your entire taxable income in charitable donations and write the whole thing off. However, most of us aren't in that situation. But if you itemize, if you don't itemize because the standard deduction is so much higher than it used to be, they're allowing you to take a $300 above the line deduction for a married couple or $150 if you're single. And above the line deduction on charitable donations this year. So you get a benefit even if you've given only $300. So that's huge because a lot of us, we're forced to take the standard now because of the limited taxes and the number's so much higher. You can now do a $300 donation. In 2021, they doubled it and said $600 for married filing jointly and $300 if you're single. And they still have the 100%. So for 2020 and 2021, there's an extra charitable donation. I know a lot of us don't, keep our receipts as much as we'd like anymore because we're like, well, we're not going to benefit us anymore. Now you do that. The thing is, it has to be cash. It can't be clothing. It can't be a piece of art, though. Why you would do that? Probably not, but it has to be cash. Here's some charts. Let's talk about the standard deduction. You can see it's going up with the cost of living increases. The child tax credits, $2,000 per child under the age of 17, 16 and under. $1,400 of it's refundable. There's an other dependent credit for all those kids that are above that and are still college students. You still get $500 for them. And then the credit thresholds are for a single or head of household, it starts at $200,000. If your AGI is above 240,000, it goes away. Married, it's 400,000 or 440,000. So there are those. Some credits there that you can take care of, but there's no increase in the last couple of years. That's what it is. I have provided you some charts here. These are the tax brackets for year over year. The rates are going up every year a little bit. I mean, the income is going up a little bit. I provided tracks for single, married filing jointly, and head of household. So these are here for you guys to use if they interest you. If you have some idea. Long-term capital gains rates. Here are those for single, head of household, married filing jointly. Provided this chart here simply for you guys as a frame of reference for rates. Retirement savings. These are things that you can do. This is showing you the amounts for the next couple of years for 2020 and 2021 for SEPs, 401ks, and regular IRAs. And then there's the catch up there if you're over 50. So there's those amounts. There's that. Now for stimulus update. All right. So the first one is the PPP or payroll protection loans. And we're just going to talk about, we've all seen these. We know what they are. Certain supportive wages for a certain amount of time. Their question was, we weren't sure if they were going to be taxable, if the expenses were going to be taxable, would they forgive it, but make the expenses? And so what's ended up happening is that the federal government with the CARES Act said that the expenses are still deductible and you don't have to pick up the PPP as forgiveness. So you get the best of both worlds. You get to keep the expenses and you don't have to pick up the income. And then Pennsylvania, I think it was like last week or the week before, came back and said, fine, we're going to follow PA. And so, we're going to follow the Fed as far as they're going to do the same thing. Originally, we thought there was going to be different rules, but it turns out, nope, they went exactly the same. The EIDL, the economic, those grants, they're non-taxable, both Fed and PA. We've gotten those. Some local grants, none of them are taxable, so we can write all those off. The recovery rebate credits, those are those checks that came out. I think the first one came out like May, June, July timeframe. And then the last one came out either in December or in January. That's the $2,000 check. And then is it 2,000 or 1,200? I think it's 1,200. I don't know, whatever the first check was. And then there was the second check in December. You are required to report those on your personal return this year, both sets of checks. And if you ended up, like, let's say you were supposed to get X and you were supposed to get even more, that's a credit you can get on your return this year. So the IRS will give you the money if you didn't get it. You can report that and they'll say, oh, hey, we owe you money, and it's a credit on your tax return. It's completely refundable. And if they find out that, hey, you got more than you were supposed to, no worries. You're not required to pay it back. They just want you to report it so that after you file your taxes, you can no longer come back to the government and say, hey, I didn't get my stimulus check. This is the government's way of saying, hey, if you didn't get it because we messed something up or there was some reason it was held on to, you file your taxes in 2020, you're going to get your stimulus check or your recovery rebate check. All right. That's these two, not the one that's being debated now, but that's these first two. Second round of PPP. Lindsay, do you want to talk about this? You're much more in the weeds with the second round of PPP that's going on right now.
Yes, second round PPP is going on right now. Thank you, Charlie. This was a recently passed legislation. You must have less than 300 employees. You need to be able to look at your quarter over quarter financial statements, whether it's in Excel or a QuickBooks Online version. You need to be able to compare any quarter in 2020 to the very same quarter in 2019 and show a greater than 25% reduction. If you can show this, so if you didn't have any income or March and April were tough months, those are when we're seeing it the most for the majority of our clients. At that point, if you can show the 25% greater reduction, you may use that detail and documentation to apply for PPP round 2. Likely you'll fall below the request for more than $2 million. You probably won't be requesting that much, but businesses cannot request more than $2 million at this point for a loan. And the loans are going to be available here through the end of March. There was new legislation that came out within the last 48 hours that is going to give a 2-week specific period of time for small businesses from February the 24th, starting yesterday, through March the 9th, where businesses with only 20 or fewer employees will be eligible to apply. This is going to give the various banks some very focused and direct ability to go ahead and give funding to the businesses who need it the most. In this calculation for the second round, it is really geared towards sole proprietors, independent contractors, and self-employed individuals. That is you all. So we want to make sure that you are taking a look at your quarter over quarter financial statements. So I know you guys get paid out on a monthly basis, and you can either line that up by month, squish it into a quarter, run some totals and figure out that calculation. But they are really gearing some specifics to the areas and the people who need it most. Additionally, if you've had any troubled past or backgrounds, they are reducing some barriers for people who have had delinquent taxes, delinquent federal debt, delinquent student loans, and any previous convicted felons. So they are reducing that. Previously, those were all disallowed qualifications and you weren't eligible to get a PPP loan. We have seen businesses in the most recent rounds having difficulty for back taxes, whether it's back payroll taxes, back personal taxes, any sort of back business taxes, or having other penalties or interest on file. So make sure your businesses are up to date to avoid any issues with round 2. And then we're also starting to see the act also allowed for business owners who aren't US citizens to apply who are running various businesses here as well. So those previously unqualified applicants now do become applicable. And they, like I said earlier, they really are trying to gear it to those within that 2 week that really need it the most, and help out the small businesses at this point. Charlie, I'll turn it back over to you for the next slide. Oh, you're on mute, I think.
Thanks. The other big one that we have going on is the employee retention credit. And this is huge because before it was either you got PPP or you got ER, employee retention credit, but you couldn't get both. As part of the CARES Act, they said, nope, we don't care. We're going to go back. We're going to say you can get both. And the employee retention credit is you can get 50% of wages if you were shut down, if your business was partially suspended, or you had significant drops in gross receipts, you can get this credit. It's $5,000 per employee in 2020. If you had a 50% drop in gross receipts, but in 2021, it's only a 20% drop in gross receipts, and it's $14,000 per employee. So it's much, much bigger. And it's a payroll tax credit, not an income tax credit. So if you're a sole proprietor, you're not going to be able to get this. But if you have wages and you have employees, it's something to get. I have a link in here to our blog where it talks about it. So I have that there. If specifically about the employee retention credit, if you think it's something you might be eligible for or know somebody, you can go to that link. They can fill out a little bit of a form, and then someone from our office will contact them to help work with them to get their employee retention credit. And then some other small COVID type credits. There's the Family First Coronavirus Response Act, and that's a tax credit if you paid an employee while they were taking care of somebody who was, if you allow them to work, pay them while they're off taking care of somebody who has COVID, you can get a tax credit. Your business can get a tax credit for that. Then there's the employee payroll tax deferral, which barely nobody did. And then there's the employer payroll tax deferral, which some people have done. It allows you to defer your payroll taxes for a year or two, and then you have to pay it back. The employee is the same thing. You're employing the employee's portion, but the problem is that employee leaves, you got to pay for their payroll taxes, and it got very messy. So that's why not only the employee, but there's the employer out there. And so those are two other ones that aren't really as relevant, people aren't really using. But the PPP and the employee retention credits are both hot ticket items right now.
And if you need any assistance with either one of those items, we are very well versed in both the application process. We have worked with several local banks. Two of our favorites are Orrstown and Mid-Penn. Both have been leaders in the areas accepting applications. It's noteworthy to let you know that Mid-Penn was one of the largest national providers for various loans, ranking nationally, which I thought was really awesome for a small or a smaller central PA bank. So they were even accepting round 2 days before they were even eligible to go live. So if you need assistance, directions on where to find those forms or how to find them, please feel free to reach out. That's separate. And then the last thing is not only is this for the ERC, but down here we have a link to our COVID-19 blog where articles are shooting out there all the time about different coronavirus topics. So I encourage you to sign up for it. You'll just get emails every so often, and they're always good things. They're never really all that long, and they just kind of keep you up to date on the latest and greatest in the in what's going on with COVID-19 and tax policy and other things, but mostly taxes. Right. All right, and then our last part here, we're going to talk about Joe Biden's tax plan. And so these are just the things that he said he was going to lay out. So not to say that any of this could happen, to give you some idea of where he's thinking. Okay. So on the individual side, Biden wants to go back to the pre-Tax Cuts and Jobs Act for that top rate of 39.6% instead of 37%. He wants to keep all the other rates the same. He's just going to create another rate of 39.6%. He wants to be able to, if you make more than $400,000 a year in wages, so highly compensated executives
have to pay Social Security on income over $400,000. So if your wages are more than 400,000, you're gonna have to start paying Social Security again. For those of you who aren't aware, once you get, I think it's like 138 something or 137 something in wages, you don't have to pay Social Security anymore. You just pay the Medicare, which is like 1.6%. What Biden is suggesting is that it's creating almost like a donut where you pay Social Security at the bottom, then you have like a hole in your donut where you don't pay Social Security, and then when you get above 400,000, you're going to start paying Social Security again. Capital gains and qualified dividends would be taxed at ordinary rates. Right now, they're at that preferred rate, which is why I provided that chart. But he's saying if you make more than $1 million a year, you're going to pay ordinary rates. He went that QBI deduction we talked about. If you make more than $400,000 a year, he wants to eliminate it, which just means making sure you get those deductions in are even more important. And then he's going to cap itemized deductions. And essentially, it's going back to the way things were, saying that like, the P's limitation and making it 28%. So just know that itemized deductions could be limited, but only if you're in the very high $500,000, $600,000 tax bracket. For most people, none of this is going to affect you. On that first page. On the second page, that retirement contribution thing is actually kind of neat. What he says is if you make a 401k contribution and you're getting a benefit on your income tax bracket. So if you're in the 12 or the 22 or the 24% tax bracket, for every dollar you contribute to your 401k, you're getting essentially a 24% tax savings. What he's saying is that he wants to make it that you no longer will your federal wages be less than your state wages. He's just going to give you a 26% tax credit on what you contribute, which for most Americans who are in the 10, 12, 22% tax bracket, you're going to make out. It's for the higher income earners who, if you're making 37% tax bracket and you can contribute, you're getting a 37% tax deduction where lower income earners are only getting a 10. So this kind of evens the field for everybody. You get a 26% tax bracket deduction for all 401k or IRA deductions. Expanded earned income tax credit for seniors. He's going to increase the child tax credit to $3,000 instead of $2,000 and $3,600 for anybody with children under 6. And he'd like to make it completely refundable. So right now, only $1,400 of that's refundable. He wants to make the whole thing refundable. The expanded child and dependent credit up to $8,000 in expenses for childcare instead of just the $3,000 that we do right now. And as anybody with kids can tell you, daycare for the year is way more than $3,000 a year. So that would be huge. And it's worth noting that the child tax credit and the dependent daycare credit is one credit that never expires with income. You are always eligible for that credit as long as both parents are working and you make more than the credit. So that's a good one. And then a first-time home buyer's credit up to $15,000. This credit was around, which is good for you guys. I don't know, depending on how long you guys have been doing this. I know back in like 07, 08, when the housing market crashed, they came up with this. It was a loan, a tax-free loan, and then it became a credit, like maybe 09. I forget when they did that, but they'd like to bring that tax credit back for the first time you're buying your home. That credit. Estate taxes, just real brief. Biden wants to eliminate the step up when you pass away. When you have a parent who die, they get a step up to fair market value. And he wants to return to 2009 levels. So a $3.5 million exemption instead of $11.58 million exemption, and increase the match rate back to 45% instead of 40%. So that's something that he wants to change on the estate tax side. And then lastly, on the business side, he wants to increase the corporate rate up to 28%. He wants to create a 15% minimum tax if you have financial statements. So it's the greater of what you would owe, or the 15% of your like book income almost, but only if you have financial statements and only if your income exceeds $100 million. So nothing we have to worry about, but I threw it in there for completeness. an offshore tax penalty that would now apply to overseas call centers. And then a made in America 10% tax. So those are the major things that are going on with Joe Biden's tax plan. I wanted to share those. And so there's our email, our phone numbers, our pictures. So you know what we look like, even though now we're on a Zoom call and you can see that. Does anybody have any questions for Lindsay or I here? We have about a couple minutes left. Does anybody have any questions on anything? We'll do our best to answer.
If anybody has any questions related to their ongoing tracking mechanisms, we do suggest that you utilize either QuickBooks desktop version or the online version. This is a great way to help you with your business expenses being segregated between a business and a personal account. We do suggest that segregation. All monies coming into that business account should be classified as your income. And all those outgoing business related expenses are your deductions that would be utilized for your Schedule C. That's the best way to keep them as separate as possible. That avoids additional kind of that can of worms that could be opened in the event that you are audited, and it opens it up to your personal endeavors or personal transactions you have running through a business account or business transactions running through a personal account. So we do suggest that you do separate those out. And having a separate business account does allow you that flexibility to make sure that you're only putting business related income and expenses in there. Additionally, a large question we always get is, how do I pay myself out of that account? You can make your transfer directly to your personal account instead of running ongoing personal charges through there. So we do recommend you quote, take that distribution and pay yourself by transferring to your other account. If you have any questions as to how to utilize QuickBooks or if QuickBooks is right for you, I'd be happy to answer that for you. I know Nathan dabbles in that a little bit too, and likely he could give you some recommendations too that other agents may have done or are doing currently. So thank you one and all for your time. Nathan, I guess I'll turn it over to you and allow you a closing remark.
Yeah, thank you guys so much. A lot of information I didn't even know. So I really appreciate your time and putting all this together for us. Are there any other questions, Maggie, Tammy, Tasha, Cindy, that you might have before we go? Nope. All right. Thank you all for joining. Thank you guys.
Thank you.
Take care.
Thank you.
Bye.